Silver tends to be twice or extremely volatile when compared to gold. And the move back up, which is a lower high, comes in at 97. And then the low that follows it is basically a double bottom here or here. It's a little bit below that. It's nothing for silver when it's running hot to move in decimals of $5, $10 on a daily basis. Now, corrections were rather shallow. If we did a fib retracement like I have on other charts, you'd see it probably comes to the 38%, but it doesn't go down like to a 61% retracement. This really illustrates just how quickly the price of gold accelerated, because you can see that this angle is a little bit steeper than this one, corrects, and then the final one to complete the motive phase, meaning get to the fifth wave. It's undeniable the kind of parabolic move we saw at this fifth wave as gold's sitting at around 46.17. The pivot has occurred from bearish to bullish.
You're not just saying, gold is rising. You're saying each leg has become steeper and more powerful. When you see the last rally travel almost twice the distance in roughly half the time, I mean, what does that tell you about this bull market? Explain that chart that you pulled up for us.
Sure. Well, the chart that we're looking at really starts at the end of 2024, beginning of 2025. And you can see these three white boxes. And obviously, each box represents a leg of the rally that composes the 5 count. In other words, wave 1, our corrective wave 2, 3, 4, and 5. Now, we've talked about that before, but what I wanted to do was to lend some insight. And to do that, I've drawn a basic technical study which plots time and price, as well as the angle of the rise and the basic numbers, the outcome of each of these rallies. So this rally that started at the beginning of 2025 all the way up to middle of April took gold from roughly $2,600 and concluded at about $3,500. So gold gained over $900, and that is a net increase of about 35%. That's a tremendous move. Now, the corrections were rather shallow. If we did a fib retracement like I have on other charts, you'd see it probably comes to the 38%, but it doesn't go down like to a 61% retracement.
Markets climbed, but liquidity stress indicators moved the opposite direction again. According to Gary Wagner, accelerating gold rallies rarely appear without deeper sovereign debt instability underneath. 3 advances compressed into shorter time frames, while correction stayed shallow, signaling institutional urgency instead of speculative enthusiasm. Central banks continue accumulating bullion, while publicly defending confidence in fiat stability and controlled inflation expectations. Retirement portfolios tied heavily to bonds face purchasing power erosion if this velocity persists through another quarter. Next, Gary Wagner exposes why shortening rally cycles concern institutional allocators watching liquidity conditions.
And the other thing that I want you to make note of is this green line, simple 50-day moving average, which in essence tells us that we have had a full-blown bullish trend, aside from a couple of times when prices went right to but didn't remain there, didn't dip hard until the correction up here. So we complete the first, wave 1. Wave 2 typically can never be the shortest of the impulse waves, doesn't have to be the longest. And in this case, we get what's called an exaggerated fifth, so it doesn't meet that criteria. But on this one, it started mid-May, gold's at 3,100, and by the conclusion of the rally, middle of October, it had run to 49.94. We're rounded up to 4,400. Total dollars gained per troy ounce, $1,286 was added to a troy ounce. And so when we look back and go, God, wasn't gold just at 2,000 or 3,000? Yes, it was. And this really illustrates just how quickly the price of gold accelerated because you can see that this angle is a little bit steeper than this one, corrects, and then the final one to complete the motive phase, meaning get to the fifth wave, that gained $1,736, a 44.61% rise. That's a huge rise. And here's the interesting thing. The number of bars, this is a daily chart that it took, was 63 trading days, whereas the middle one took 109 trading days, and this first one took 83 trading days.
This happened before prior monetary regime shifts too, and the timing matters more than headlines. What Gary Wagner is highlighting is how accelerating rallies compressed despite tighter policy rhetoric from central banks. Gold advanced faster with each wave while trading days declined sharply, revealing urgency beneath institutional positioning behavior. Officials continue signaling economic resilience even as defensive asset accumulation suggests rising concern about systemic liquidity durability. Savers relying on conventional diversification may underestimate how quickly currency purchasing power can deteriorate during compression phases. Next, Gary Wagner reveals why faster rally cycles often precede broader confidence fractures in credit markets.
So we had really a huge compression in terms of how quickly it got there. And although you can see that each rally peaks with almost a parabolic move here, almost a parabolic move here, it's undeniable the kind of parabolic move we saw at this fifth wave as gold sitting at around 46.17 and pops all the way up. This is a wick which is being covered by a line above $4,600. And, I remember what it was like middle of 2011 when we watched gold basically go a little bit before that 1,000 and then to break 1,900. It was truly a historical time. And it doubled in price. But this is a lot more than doubling in price.
Yeah.
And the fact of the matter is, there's really been no signs yet that I can see where this trend has been losing steam. If anything, it's been picking up wind, it's been picking up steam. We're getting these moves happening quicker than ever. And then, of course, what goes up must come down. And so the way I've labeled it is once we hit this top, the top itself concluded wave 5, and then it was a brutal move down. It took 2 or 3 days. And we labeled that as our A, our B, and then finally our C. And our C took us to, I think the wick came close to just about $4,100 per ounce. So considering it was at 56 and then it came down lower, it was actually below a 78% fib retracement. So that leads us to believe, well, what's going to be next?
If this continues another quarter, retirement purchasing power erosion accelerates faster than most portfolios can offset. Gary Wagner notes parabolic advances followed by violent retracements often emerge during unstable monetary transition periods. Gold doubled historical breakout speeds while corrections deepened beneath normal retracement structures within only several trading sessions. Policymakers still describe inflation pressures as manageable despite institutional hedging behavior pointing toward unresolved systemic fragility underneath markets. Investors concentrated in paper assets remain exposed to abrupt repricing events once confidence in policy guidance weakens further. Next, Gary Wagner unravels what aggressive retracements quietly reveal about institutional confidence beneath gold markets.
Again, with Elliott Wave, we don't have an indication that the pivot has occurred from bearish to bullish. Yes, we did break below the 50-day, but that's during a correction. And you'll see when we look at where gold is now, it's within striking distance just below the simple 50-day moving average, which is why I've extrapolated where I think we are now. And what that is this. I believe that we had motive wave 1, one was back there, 3, this is 5, this is our correction. Now we start the clock over. And when we start the clock over, I believe we most likely hit our primary first wave. And that started at $4,220 approximately, up to about $4,900. It challenged but did not break above the 50-day. And that's really what we're going to need for real confirmation that we're truly entering another sizable rally move that's going to really make up some ground. But the way I'm looking at it is this. This is where we're up to. This is today's activity, yesterday's. So I believe that we have completed wave 1, right, wave 2, and I believe we are in wave 3. Now, if wave 3 typically is not the shortest, it means that at minimum, we're going on wave 1, which is called a benchmark wave, from 4,200 to 4,900, so about a $700 move. So if this has that same move, 4,500, I'm rounding down, would take us to 5,200. Right. And that would be a third wave.
Large institutions repositioned quietly, while retail investors focused on short-term correction headlines. This is where Gary Wagner's thesis shifts from technical recovery toward broader institutional accumulation behavior beneath the surface. Gold challenged key moving averages again, while wave structures imply another benchmark advance could already be developing. Central banks continue adding reserves even as officials publicly frame inflation risks and debt pressures as contained. Traditional retirement allocations remain vulnerable if defensive capital keeps rotating away from sovereign debt into hard assets. Next, Gary Wagner reveals why institutional reserve behavior contradicts official confidence in monetary stability.
We would still have a fourth and then a fifth. And that's why I am so excited about this point in time, because we watched miracles happen, literally, when we saw gold move up the way it did. It was not a pleasant experience going through the correction, but I think you recall I even used the words, it was a needed expenditure of energy. It had to blow off some steam. Yeah. And I was glad that it happened. I not only believed that it was upcoming, but without it, we wouldn't get the kind of smooth wave counts and, more importantly, the smooth kinds of signals that we're getting. So I'm sorry, go on.
No. This is good, Gary, because, and I must say, over that time, I mean, you look at this chart, it's been a privilege to kind of cover these crazy, fascinating markets with you. I mean, we've seen some wild gains. And I just want to make this clear for the viewers, because you're saying wave 1's complete, wave 2 is either complete or very close to being complete. That sets us up for wave 3. And again, in Elliott Wave terms, wave 3 can't be the shortest impulse wave. So that means, or would mean, that this next phase has to take gold above the prior record high for the count to remain volatile.
Oh, you're stealing my thunder, but yes, you are correct. Okay. You're 100% correct, because the way, and realize this is not to frame, I'm not convinced where these will go, but we will get a conclusion that's roughly the same size as this.
The Fed says conditions are stable, but institutional hedging behavior keeps intensifying beneath the surface. Gary Wagner notes corrective phases often strengthen longer-term advances when liquidity stress remains unresolved underneath markets. Wave structures now imply another breakout phase could exceed prior highs despite recent volatility and sentiment fatigue. Officials continue promoting confidence while sovereign debt issuance and reserve diversification quietly undermine that public narrative. Retirement savers, relying solely on conventional allocation models, face rising exposure to prolonged purchasing power deterioration. Next, Gary Wagner exposes why policy reassurance keeps diverging from institutional positioning toward precious metals.
Then we'll have a corrective wave, and by the nature of Elliott Wave itself, and this might be a little bit too exaggerated, even if it's like here, the conclusion of a fifth wave to the next mode of phase, fifth wave, the latter one is always going to be higher than the former one. Okay, you're always going to get a higher high on the next mode of phase. If you're not, The Elliott Waves, we'll call it a truncated fifth or something like that, but it doesn't bode well. It doesn't really give you the kind of knowledge of how strong and robust and different these rallies have been. And realize this is just for illustration purposes only. I'm not saying that the third wave will move here or the fourth here. I do believe that we have completed the first. If I'm incorrect, you see each wave can be subdivided. So wave one could look like this. This is one of one. This is two of one, three of one, four of one, five of one. So there's a structure, and the way that we typically would do that from this daily, I'd convert it to a 4-hour chart. And if I convert it to a 4-hour chart, I get the wave subcount behind it. So yeah, I truly believe that we will see gold at some point before the end of the year challenge $6,000 per ounce. When I look at the historical data that preceded that, let me just scale that in. When we look at how we got here, it doesn't seem all that unlikely to me. I mean, this has not been a meek market. We've just had new record high after new record high. Yeah. We've had phenomenal rallies. We've had rallies when we expected it. We had rallies when we didn't expect it. In other words, there were quite a few paradigm shifts along the way.
Nobody's discussing how persistent higher highs often coincide with weakening confidence in sovereign debt markets. According to Gary Wagner, recurring breakout structures reflect sustained institutional demand rather than temporary speculative momentum alone. Gold kept recording fresh highs while corrections failed to reverse the broader accumulation trend across multiple cycles. Policymakers publicly defend monetary credibility even as reserve managers continue reducing exposure to depreciating fiat instruments. Investors overweight traditional fixed income remain vulnerable if confidence shifts further toward hard asset preservation strategies globally. Next, Gary Wagner reveals what recurring breakout patterns historically signaled before monetary credibility weakened further.
Hey, we got to talk about silver because it's also been a standout in this market. As on X today, a lot of people gossiping about it. I mean, it's broke above $80 an ounce. It's outperforming gold. Now, the gold-silver ratio has compressed towards 58 to 1. But I'm curious, I mean, does silver's leadership support your bullish gold thesis, or is silver kind of running its own race here?
They're both running in tandem. They're both running strong. They're both making all-time record highs. Yeah. What I'm most impressed about silver is that this one area here, beginning at the end of October 2025, silver's at 44, and it has a single rally that concludes at about $1.20 plus per troy ounce, and then it sells off tremendously, pretty much a 78% retracement, and then it becomes kind of range-bound. This is the way the correction unfolded. I'm trying to determine if we are out of the correction because you can derive a classic A, B, and C. Mm-hmm. Is this a wave one? Is this a wave two? It's possible. It's a different looking chart because of we had less legs of rallies. When we compared this to gold, we would have had two boxes, a rally, correction, a rally. This all happened at once. So it proves the thesis that myself, along with many other technicians, adamantly believe in.
This happened before prior commodity repricing cycles too, and the timing deserves closer attention now. What Gary Wagner is highlighting is silver outperforming during periods when institutional capital seeks leverage monetary protection. Silver surged from 44 toward triple digits before retracing nearly 78% within compressed trading windows. Officials continue minimizing inflation persistence, while monetary metals increasingly behave like distrust indicators against policy credibility and debt sustainability. Retirement savers ignoring silver volatility may also overlook its historical role during accelerating currency debasement phases globally. Next, Gary Wagner unravels why silver leadership often appears before broader institutional capital rotation accelerates.
And that is, silver tends to be twice or extremely volatile when compared to gold. When they run to the upside, silver tends to outproduce gold in terms of percentage gains. That's true here. And on the way down, it tends to outperform gold in terms of percentage drawdowns. It's the candle burning at both ends, burning twice as bright for half as long. And that still remains today.
Yeah, interesting. I mean, a lot of traders kind of looking at that low 80s as the next battleground. If silver breaks through 83, does 90 come into view, or is that kind of getting ahead of the chart here?
Well, it definitely comes into view. If we take a look at right after this correction, the move back up, which is a lower high, comes in at 97. And then the low that follows it is basically a double bottom here or here. It's a little bit below that. And then the next high, so we had high, lower high, lower high. When we look at lows, we go low, higher low, lower low, higher low. And so this is still working itself out. If this is a wave 3, I'm going to say that there's a high probability that we've completed the sell-off. The damage that was done was done. Answer your question directly. 90s, if it continues to run to the upside, 90 is the place to look at right there. This top came in at $90. It's at 81. You know, a year ago, if you would have said, well, a $9 move in silver, I mean, that will take forever. We've seen that happen in days this year. So that paradigm has shifted too. It's nothing for silver when it's running hot to move in decimals of $5, $10 on a daily basis.
If this continues through year-end, conventional retirement hedges may struggle against accelerating purchasing power erosion. Gary Wagner notes silver volatility historically expands during periods of monetary distrust and institutional repositioning activity. $9 price swings now occur within days, reflecting compressed liquidity conditions and aggressive speculative participation simultaneously. Policymakers still present inflation normalization narratives, while monetary metals trade like confidence erosion remains unresolved beneath markets. Savers concentrated entirely in paper assets face sharper volatility exposure once broader capital rotation intensifies across commodities.